Higher inflation and market volatility has put some investors on the defensive. On today's show, we'll examine ETF strategies for buffering your portfolio with dividend income. Plus, we'll examine why value stocks could be poised for a major breakout. Lance McGray at Advisors Asset Management joins us right after this. Hello and welcome to the program. I'm Stephanie Stanton with ETF Guide. Thank you so much for joining us. If you're new to ETF Guide TV, be sure to hit the subscribe button. This will ensure that you never miss any of our original episodes like Spotlight, ETF Battles, and the other shows in our program lineup. We also encourage you to post your thoughts or questions in the comment section below. With stock market volatility and inflation on the rise, some investors are on the defensive. But hedging your portfolio with dividend income could be one strategy for combating the challenging climate. Well, here to talk with us about that plus more is Lance McGray, head of ETF product at Advisors Asset Management. Lance, it's great to see you. Welcome to the show.
Yeah, thanks for having me, Stephanie.
So the U.S. bond market had the worst quarterly start to a new year in 40 years, according to the Wall Street Journal. Bonds are typically viewed as safe havens, as we know, with steady income. But this time around, they have been far from safe, and it's confusing to some investors. What has changed? Why is the bond market struggling, and where should investors be looking for income?
Yes, it really has been a challenging start to the year for most asset classes, and that's especially true for the bond market. If you look at most of the fixed income segments out there, including U.S. Treasuries, investment grade, high yield, are down substantially year to date. Even the broad-based U.S. aggregate bond index, right? This is a staple in many traditional 60-40 portfolios. It's down nearly 10% year to date. And to put that into context, 10% is almost twice as severe as the drawdown experienced during the taper tantrum. So yes, very challenging times here. The question really is, what's causing this? And what can we do going forward to help mitigate this type of risk going forward? So I think, I think most people would agree that the main drivers here, what is causing this, is really surging inflation and rising interest rates. As we know, inflation is a bondholder's worst enemy. And then with inflation well above 8.5%, the worst reading in 40 plus years and still climbing, we expect inflation to linger much longer than originally expected. And quite honestly, in fact, we believe we are witnessing the beginning of a rather long and lengthy secular regime change, which will last for quite some time. So the question becomes, what can we do in this type of environment? And the fact is, the same playbook, the investment playbook that we've used for decades, just isn't going to cut it anymore. In our opinion, it's really a great opportunity to deploy a new investment playbook, one that may help dampen volatility against rising interest rates and inflation. So what are we favoring in this market? I think first and foremost is underweighting longer duration assets. Number two, we're continuing to maintain our overweight on equities over fixed income, specifically within the fixed income market. Despite the potential for a slowing economy, we still favor credit risk over duration risk. Within equities, we're favoring value over growth. And more specifically, we're really focusing on quality dividend paying stocks with steady dividends, which we believe will become a very, very important component of total return going forward. And then finally, we're suggesting allocations to other higher cash flow generating assets like REITs, BDCs, and even MLPs. So certainly a really challenging environment specifically for income investors, but there are some areas of the market that are worth exploring.
Yeah, you mentioned duration risk. Managing duration risk is something that more investors and financial advisors need to plan for. One possible solution is the AAM Low Duration Preferred and Income Securities ETF, ticker PFLD, which takes a novel approach to hedging against higher interest rates. How does the fund work and who might it appeal to?
Yes, inflation and rising rates is a real problem for investors. In our opinion, like I said, we expect it to linger much longer than expected. So duration management is going to be key from here on out. The other thing that's worth noting is that despite the nominal rates are moving higher, which is a good thing for long-term bond investors, break-even inflation rates, right, is also sort of negating the benefits, right? Because on a real basis, after you adjust for inflation, many segments of the bond market are still experiencing negative real yields. And that's a real issue for a lot of investors. So that's one of the reasons why PFLD is a rather unique solution, as it offers a relatively high level of income, right? As of 3/31, PFLD's SEC yield was about 5.64 and a modest duration of around 3 years. So in this environment, it's very hard to find a solution that offers that type of income to duration profile. So a little bit on PFLD and what it is. It is the only low duration preferred product out there that focuses specifically on preferred stocks with low duration. Now, I must admit, when people think about preferred stocks, they really don't think about inflation hedging or duration management. They're probably thinking about income generation, after-tax income, and really potentially portfolio diversification as well. But when you think about PFLD and the way that we've constructed it, we're focusing on those preferreds that offer lower duration. So we're targeting securities that have an effective duration of 5 years and less. And what this really allows us to do through PFLD is reap the rewards of the preferred market, right? Higher income, higher tax efficient income, diversification benefits, but we're doing so with about a 40 to 50% reduction in duration versus our longer duration preferred products that we go up against. So very, very attractive product.
Yeah. Now, we know that duration risk also impacting stocks, of course. This has led to a massive shift in market sentiment away from those high PE growth stocks into value stocks. The AAM S&P 500 High Dividend Value ETF, this ticker is SPDV, has been the beneficiary of these changes, and you were early to alert our viewers about this. Give us an update on SPDV.
So the discussion around equity duration has really started to sort of pick up over the last few months, even the past year, as we've seen longer duration equity sectors like technology really lag other areas of the market. And for your viewers who really aren't familiar with the concept of equity duration, it's really, derived off of, the traditional bond duration calculation, right? Where the concept is, interest rates have a negative impact on longer dated bonds because the present value of future cash flows is less, right? And if you take that same logic and apply it to the world of equities, you're looking at technology stocks, right? Where the current valuations are really being driven by future earnings or cash flows. In the instance of those stocks, they carry a longer duration, or in parallel with longer dated bonds, they're going to feel the impact of rising rates much more than stocks that have, consistent dividend payments, that have cash flow coming in, and so on. So in terms of SPDV, and along with our entire high dividend value suite, is really geared around dividends and cash flow. And in this environment, that obviously shortens your equity duration. Now, happy to report, over the past, on a year-to-date basis, SPDV is still, and its underlying index is still positive year-to-date, which is very, very attractive in this environment. And it's outperforming the S&P 500 index by over 10%. So really, really attractive product right now, one that focuses on not only high dividend yield, but also dividend sustainability. It offers sector diversification, so you're not overweight in technology or other longer duration sectors. And also you have monthly distributions. Very, very, again, a very, very appealing product in this type of environment.
Yeah, it sounds like it. All right, one final question before you take off. The AAM Bahl and Gaynor Small Mid-Cap Income Growth ETF, this ticker SMIG, SMIG, was recently added to your ETF lineup. Most investors don't usually associate dividend payments with smaller companies. How does SMIG work, and where do you see this type of ETF fitting into a diversified portfolio?
A really interesting product, again, and that has quickly amassed north of $70 million in assets. So it's experienced a nice pickup in assets since inception. It is our first actively managed ETF, and it's sub-advised by our trusted partners over at Bahl and Gaynor. So if you're not familiar with Bahl and Gaynor was founded in 1990. They currently have almost $50 billion in assets under management and supervision, and they really focus on dividend growth and income strategies. Their whole philosophy is built around dividends pay dividends, and they've proven the ability to successfully manage small and mid-cap core assets through a number of various market cycles. So again, very interesting product. As you would expect through the name and the ticker, SMIG, it certainly emphasizes high quality stocks with steady earnings and dividends and looks to offer the growth attributes of smaller cap stocks with the added benefit of high income generation. So in terms of who this product is sort of geared to, certainly those that are looking for small and mid cap equity exposure, but they may prefer active management over, passive solutions, and also those that are really looking to reap the rewards or the benefits of the ETF wrapper. So we're talking low cost, we're talking transparency, and most importantly, we're talking tax efficiency. So again, a very appealing product in this market environment, one that we've partnered with Bahl and Gaynor on, and really excited about going forward.
All right. Well, thank you so much, Lance. We appreciate your insights, and we're going to have to leave it there, but it's good to see you. Thanks for being with us.
Thanks, Stephanie.
And to learn more about dividend income investing and ETF lineup at Advisors Asset Management, visit aamlive.com. The link is posted in the description section below. And don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs like this one, along with ETF Battles and the many others. You can also find us on Twitter at ETF Guide. I'm Stephanie Stanton. Thanks so much for watching.